Most people never get there. Not because they are lazy, not because they do not earn enough, but because nobody ever told them what actually happens when you cross that line, and why crossing it feels like the rules of money quietly change without anyone announcing it. $100,000. It is not a yacht. It is not a penthouse. By any reasonable measure, it is not even that much money anymore. But something strange happens when that number appears on your net worth statement for the first time. Something that has nothing to do with how rich you are and everything to do with how money actually works. This is not a motivation speech. This is not a guide to getting there faster. This is an explanation of what happens after, and why the financial system starts behaving differently toward you the moment you cross that threshold. Pay attention. Let us start with a number that almost nobody talks about. The median net worth of an American adult under 35 is around $23,000. Not because young people are spending irresponsibly, though some are, but because wages have been relatively flat for decades, while the cost of housing, education, and healthcare has tripled. If you are in that group, the idea of $100,000 in net worth sounds like a destination, a finish line, something you will celebrate when you finally reach it. But here is where the story gets interesting. $100,000 is not a finish line. It is a door. And on the other side of that door, the game of money works differently than it did when you had nothing. To understand why, you need to understand something about how wealth actually grows and why the shape of that growth matters more than the number itself. In 1965, a mathematician named Benoit Mandelbrot published a paper that rattled economists. He was not talking about money exactly. He was talking about the shape of things, how coastlines are jagged at every scale, how patterns repeat, how certain systems do not grow in straight lines. They grow in curves that keep getting steeper. Compound interest works exactly like that. You have probably heard about compound interest before. You might have rolled your eyes. But most explanations skip the part that actually matters, which is this. Compounding only feels magical once there is enough base capital for the interest to outpace your lifestyle. Here is the math made brutally simple. At $10,000 earning 7% annually, you gain $700 in a year. That is a nice dinner out every month. Meaningful, but not life-changing. You could replicate that result by skipping Starbucks. At $50,000, same return, you gain $3,500. That starts to feel real. That is a small vacation, or 3 months of car payments, or a meaningful dent in a credit card. At $100,000, same return, you gain $7,000 in a year, without working for it, without thinking about it, while you sleep. Now here is what nobody says out loud. $7,000 is, for a lot of people, roughly 3 months of rent, which means that at $100,000 in invested assets, your money is quietly, invisibly paying your rent. And you are probably not even noticing it because it is showing up as a bigger number in an app on your phone. That is the first shift. Your money stops being a scoreboard and starts being an engine. But that is only the mechanical part. The psychological part is stranger. There is a concept in behavioral economics called the aspiration gap. It describes the distance between where you are and where you imagine yourself being. When that gap is enormous, when you have nothing and wealth feels abstract, money decisions are mostly about survival and short-term comfort. You spend to feel okay. You save when you can. You take the job that pays more, even if it costs you something else. When the aspiration gap starts to close, behavior changes. Studies from the University of Toronto found that people with some accumulated wealth make measurably different financial decisions than people who have nothing, even when controlling for income. They are more patient, more willing to accept delayed gratification, more likely to evaluate risk differently. The reason is not moral virtue. It is not discipline. It is margin. When you have nothing, every financial decision carries existential weight. One bad month can spiral. One unexpected bill can wipe out weeks of careful saving. That kind of precariousness keeps your decision-making trapped in the short term. Not because you want it to, but because the math demands it. When you have $100,000, a $2,000 emergency is annoying. It is not a crisis. And that gap between annoying and catastrophic is where rational long-term financial thinking begins to breathe. This is one of the quiet cruelties of wealth accumulation. The behaviors that help you build wealth, patience, long-term thinking, accepting short-term discomfort, are most available to people who already have some buffer, which is another way of saying that financial behavior is at least partly a function of financial security, not just character. Now let us talk about access, because this is where things start to feel slightly absurd. The financial system is, in a word, tiered. This is not a conspiracy, it is just design. And the design rewards the people who already have money with the cheapest possible access to more of it. When your net worth is close to zero and your credit is mediocre, your options look like this. High-interest credit cards, payday lenders if it gets bad enough, car loans at 14%, personal loans from banks who seem personally offended that you need one. As your net worth grows, something starts to shift. Slowly at first. $100,000 in a brokerage account means you can access margin lending, borrowing against your portfolio at rates that are significantly lower than a personal loan. Not always wise, but available. Your bank starts offering better products. Some doors that were previously locked quietly open. At $500,000, you become an accredited investor. That is not just a label. That is legal access to a different category of investment that ordinary people cannot touch. Private equity deals, hedge funds, venture capital structures, real estate syndications with returns that rarely make it into public markets. At $1 million, you become a high net worth individual. Private banking, dedicated advisors, tax strategies that are technically available to everyone, but practically accessible only to people with enough complexity to justify the cost of implementing them. None of this is secret. All of it is legal. And the compounding effect of these tiered advantages is that the financial system is quietly, structurally designed to accelerate wealth for people who already have it. $100,000 is not the top of this ladder. It is the first rung where the ladder actually starts to feel solid. Here is the part that takes some people by surprise. Getting to $100,000 in net worth is, statistically speaking, the hardest part. Not because the math is harder, because the behavior required is hardest when you have the least margin for error. Once the engine starts running, once compound growth is working on a meaningful base, the math begins to do work that behavior alone could not accomplish. Not automatically. Not without continued contribution and discipline. But the ratio shifts. Your savings still matter, but they matter differently. Less like a bucket you are filling, and more like fuel you are adding to something that was already burning. And this is what people mean when they say the first 100,000 is the hardest. It is not inspirational poster logic. It is a mathematical reality grounded in how compounding curves accelerate at scale. Charlie Munger, the late partner of Warren Buffett, once said that getting to his first 100,000 was the hardest thing he ever did financially. He called it critical. His exact framing was, I don't care what you have to do. If it's legal, I don't care how unpleasant it is. You need to get your hands on $100,000. That quote is usually shared as motivation. But read it again. He is not describing ambition. He is describing a structural reality. Get there by whatever means you can, he is saying, because the rules change on the other side. But we should be honest about the other side of this story, because there is one. The shift that happens at 100,000 is real. The compounding effect is real. The psychological relief is real. But the risks that appear at that level are also real. And they are different from the risks you faced before. When you have nothing, your financial risk is simple. You might not make rent. You might go into debt. The nightmare scenarios are visible and immediate. When you have accumulated wealth, the risks become more abstract and in some ways more dangerous. You start to have something to lose. And that changes behavior in ways that are not always healthy. Research on wealth anxiety shows that people with moderate wealth, say between 100,000 and 1 million, often experience greater financial anxiety than either people with nothing or people with substantial wealth. They have enough to worry about protecting, but not enough to feel truly secure. They are caught between the psychology of having made it and the reality of how precarious the middle really is. Inflation erodes purchasing power. Market corrections happen. Medical events can still devastate finances even with 100,000 in the bank. The buffer is real, but it is not invincible. And people who mistake a buffer for security sometimes make decisions that expose them to new categories of risk they were not facing before. There is also something less dramatic, but equally worth naming: the identity trap. When your net worth becomes part of how you think about yourself, protecting it can start to feel more urgent than growing it. People slow down, they take less calculated risk. They move from an accumulation mindset to a preservation mindset before they have actually accumulated enough to warrant preservation. The 100,000 becomes a ceiling instead of a floor, not because they stopped caring, but because they started caring about the wrong thing at the wrong time. Here is the wider frame. The current generation building toward $100,000 in net worth is doing so in an environment that is meaningfully different from the one their parents faced. Housing prices in most major cities have decoupled from income in ways that were not historically true. Student debt has restructured the starting point for millions of people. The stock market has provided extraordinary returns over the last 15 years, but almost entirely to people who were already in it, which means the gap between people who crossed the 100,000 threshold before 2010 and people trying to cross it now is not a gap in effort or intelligence. It is a gap in timing. And timing in wealth accumulation is deeply underrated as a variable. The people who got in early did not necessarily deserve it more. They just got there when the compounding had more runway. This matters because it reframes the cultural story we tell about wealth. The narrative that $100,000 net worths are built entirely through discipline and frugality ignores the degree to which that number is made possible, or nearly impossible, by the structure of the economy you happen to be in at the time you are trying to build it. That is not nihilism. It is not an excuse to stop trying. It is just an honest description of the terrain. So where does this leave us? $100,000 changes the math. That much is simply true. The engine of compound interest becomes meaningfully powerful at that scale. Access to financial tools improves. The psychological burden of financial precariousness starts slowly to lift. The rules, not all the rules, but enough of them, quietly shift in your favor. But it does not change the terrain. It does not make the market predictable. It does not insulate you from health crises, job losses, or the broader structural forces shaping an economy that is still, in many ways, being reorganized in real time. What it does do is give you options. Not certainty, not safety. Options. And in a system designed to compound advantage for those who already have it, options are not a small thing. The question worth sitting with, the one nobody can answer for you, is not how to get there. There are thousands of answers to that question. The harder question is what you do with the door once it opens. Whether you walk through it with a clear sense of what you are actually trying to build, or whether you spend the next decade protecting a number on a screen while the real game moves on without you. Most people spend years trying to get to 100,000. Very few people spend any time thinking about what kind of person they want to be once they do. That might be worth thinking about before you get there. If you found this video useful and want more breakdowns like this one, please like and subscribe. It is the simplest way to help this channel keep making content that respects your time and your intelligence.